Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates, and those 10-year note yields started to creep higher early in the session. We got as high as 236. It's the highest we've been going back a few months, and then things started to come back. We saw a reversal. We saw bond buyers step in. We saw yields decline, and ultimately, I think right now it seems to me that the market is now waiting, and what it's waiting for is perhaps even a push even lower back to 2.25 to get us kind of back to that equilibrium level, or it's waiting for somebody else at the Fed to say something a little more hawkish, because if you go by last week's September FOMC minutes, it seems that the market was very on board for more rate hikes and balance sheet normalization. We saw yields shoot up and the curve steepen. However, it just seemed today things got a little muted. So 10-year yield, it's still higher from FOMC last week. However, we are starting to see them creep back lower. And in that, we see a big move higher and a quick move lower. You would think to do something in volatility, but market volatility remains pretty absent from any talk, absent from any trade, as it kind of hovers still near year-to-date lows. So very, very little excitement, very little fear priced into the market. That takes us to our last point, is that with the Fed coming in and talking about raising short-term rates, yeah, the 2-year and 5-year sector has seen yields go higher, and we have seen odds of a Fed rate hike increase significantly over the last several weeks. However, without a long-term plan, we aren't seeing the same behavior in the longer-term yields. So we're seeing 30 and 10-year yields creep higher, but now have pulled back significantly. And I think that all has to do with the fact that, well, if we look at December as a rate hike slam dunk, you really can't look any further without knowing who the Fed chair is, who the Fed vice chair is going to be, and without some more detail and breakdown in some of these growth numbers. We got revisions to second quarter that told us that this is the highest growth we've had in a few years. Great. But we're not seeing that today, and we're going to get third quarter growth at the end of October, and then we'll get fourth quarter growth not until January. So there's a little bit more to be said and had here before we can start to talk about 2 to 3 rate hikes every year in perpetuity going out. So right now, I think the Fed is keeping things, wants to look more long-term, but the market is looking at things very short-term, which I think why is you're going to see those longer-term yields stay lower than expected. This has been Todd Colvin coming to you from the floor of the CME Group.